Welcome to TheoTrade. This is Don Kaufman. It's November 26, 2018, and you are watching the TheoTrade evening video. All right, rip and rally inside of the S&Ps tonight. We'll keep it rather short and sweet on this Cyber Monday. Listen, nothing has changed in terms of volatility. What do I mean by that? Well, what are we doing? When we define volatility these days, we don't necessarily cruise over and look per se at the VIX. We're talking about bouncing between specific levels, okay, which again, we kind of term gravity points. Here's our gravity point of 2682, ripping down to the 2626, and today we're right back up. In fact, in the after hours here, I would fully expect us to come right back into that point of 2682. Now, that's how we kind of define a little bit of volatility. How else do we define volatility? Look at the number of like 1% plus days that we've had in this quarter. It is absolutely uncanny. We're already well above average, and we still have, over a month to go in the quarter. So with that, what do we look at on a day like this? Well, first and foremost, so the S&Ps, rip to the upside. And I make no two ways about this. I happen to carry bearish trades. Okay, what that effectively means is negative delta. What negative delta implies is, well, that I'm short in some way, shape, or form. Either I'm short in S&Ps, I could be short in the spiders, I can be short in the financials. Lo and behold, I've actually got a little bit of everything. Short here, short there, short everything, including a partridge and a pear tree. My positions, though, at a time like this, even though I'm short, I fully expect some rallies back up. And most of the quote-unquote short positions that I'm in, they're what we would term duration positions. And that effectively means, okay, I have a time or a duration, if you will, in excess of 3 months in mind. That my bias right now and my bearish bias, it's not for tomorrow, okay? It's not 3 days from now. My bearish bias happens to be a little bit of the duration. That is, again, in excess of 3 months. And I've kind of laid out, categorically speaking, both fundamental reasons, okay, and technical reasons, and even quantitative reasons, for that kind of bearish nature. However, as I said a moment ago, nothing has really changed here. So what? We bounce back up. Okay, this is what we expect in the midst of volatility, what we term our rip and rally. Okay, we're cruising right back up to a gravity point. One thing that really stands out today, there's rather light volume inside of the S&P futures. Okay, maybe because it's Cyber Monday, I don't know. Maybe because it's a rally. But look, when I say something stands out over here, listen, this really stands out. Like the volume, it's just not there. In fact, if you highlight the last couple of trading sessions, obviously this is the Wednesday before Thanksgiving, right? So right there is the Wednesday before Thanksgiving. We did slightly higher volume, but the Wednesday before Thanksgiving, it's the heaviest travel day of the year. This is a half a trading session over here on Friday, and here we are on on Cyber Monday. For what it's worth, most of the good sales were over by probably Wednesday or even Thursday during Thanksgiving. But when nothing changes, and I say nothing changes, so we do a low volume kind of rally back to the upside. There's no question that some of this can kind of grip hold. Again, a few kind of key factors. One of them, yes, volatility did drop to a degree. The bonds didn't play any role whatsoever into today's rally. Now, time out. Why do I jump to the bonds over here not playing a role? December, which we're coming into here, is just chock full of headline risk. Speaking of headline risk, this week of trade is filled with headline risk. In fact, I'm actually surprised to see the volatility back off at all. Again, some people look at the VIX. All it's doing is, all right, listen, we just rallied 1.73% in the S&Ps. You got to have some give and take relationship in the volatility, right? And the S&Ps, took back 1.7%, and again, the volatility came in. But when I say this entire week is going to be chock full of headline risk, I mean, you've actually got G20 Summit. I could go on for 20 minutes about all the headline risk. You got to be careful, especially this week as an intraday trader, because there's going to be what we also term tape bombs, Twitter bombs, right? That is tweets that can really rock markets in a very short amount of time. Now, all right, so the volatility comes down a little bit. Okay, the XLF. I got to go to the XLF because I just ad nauseum have been talking about this 2650 level and pretty much closed on it today, which is no surprise. Why did it close on it and why is it no surprise? Because that's the level that'll torture Don, me, the most. So this 2650, and that really is, to me right now, it's our bullish bearish indicator for the S&Ps. It truly is this line in the markets, and anything above it happens to be bullish for the time being. Anything below it is fairly dire and bearish. So, all right, S&Ps rally, but they do it heavily on the heels of what's going on inside financials. Now, most people will actually point out, well, look, take a look at Amazon, an explosive move. Yeah, however, Amazon has been absolutely hammered day in and day out. All we're getting, okay, strictly my opinion, is a little bit of a rip-your-face-off rally inside of Amazon, which has, again, been just chock full of pain lately. Moving down the list to some of the usual suspects, though, a bit of a bounce back inside of Facebook. Apple, during portions of the day, was actually down, okay, and rallied back up. But Apple, again, let me reiterate this. This is a little bit more of a bearish take. Things up 1.37 on the entire year. So, I'm going through a couple of major, names over here, but there's a few things that really do stand out. So when you think about holiday sales and retail sales, a lot of brick and mortar stores had declines year over year, okay? Though, if you take a look at something like Costco, it actually happens to be down on the trading session, okay? Walmart, effectively flat on the trading session. And these two underlyings, though, have actually been boasting how good their online sales are. Now, the reason I want to reiterate this is because all we're seeing today, again, it appears to be nothing more, okay, than a bounce back in the marketplace. And a bounce back like this, okay, the first move to the upside, I'm going to go back to the S&Ps for a second, but this first move back to the upside over here, this is not the day that I'm going to initiate more short positions. Okay, if the market really kind of catches fire, takes back off to the upside, okay, comes anywhere near this 27.31, I will start to throw on, again, just a few more bearish trades, maybe some in-out spreads. Today, for the most part, we saw low liquidity. Even the bid-offer spreads weren't great today. Kind of stood back, all right, and are kind of marking some time. One other aspect just doesn't seem all that advantageous right now. Happens to deal with skew. This is a little bit more in depth for those of you that are a little bit, I would say, up the learning curve of trading. If you look at a 10-year weekly in skew, and I was pointing this out inside of chat, and bear with me here momentarily as I take this off a percentage. Okay, so if you look at a 10-year weekly inside of skew, and what skew is, it's measuring the out-of-the-money puts versus the out-of-the-money calls. The skew is incredibly low, okay, right now. And again, the skew relates specifically to the S&Ps. What this in effect says, we'll cruise over to the SPX and explain precisely what it says, but what the skew actually says is that the out-of-the-money puts, okay, the out-of-the-money puts in the SPX are trading, okay, relatively inexpensively versus the out-of-the-money calls. Now, the opposite has been true of skew, okay, coming into the month of October. So if we open up, again, just a ton of options, and we'll just go to the 24-day expiration, and we'll open up all options, okay. In effect, what we're saying over here, okay, and I think that this is an area that is important, even if you don't necessarily understand skew. It's an area of importance to understand in the marketplace, okay. So here we have our at-the-money options, and our at-the-money options are trading for about 17% IV. Okay, so that's the at-the-moneys are trading for about 17%. And the further you go out of the money on the puts, okay, so the further we go out of the money on these puts, and you can see obviously these markets are still open, okay, the puts, they're, and again, here we are, $120 out of the money. The implied volatility is only minimally above the at-the-money, which in effect tells us there's a ton of big traders selling out of the money puts. Now, take that for what it's worth. Now, they're selling puts. Are they selling puts because they're bullish? Maybe. Or they're selling puts just because the volatility is inflated. All I know, okay, is in an incredibly low skew. That puts a tremendous number of traders at risk for a down move inside of the marketplace. Something to think about. Again, it's a very, very flat skew. People right now, they're starved, okay, for yield. And coming towards the end of the year, they're doing anything, okay, to squeeze out some juice, to squeeze out a little bit of alpha, to squeeze out any return. Okay, you can feel it inside of the marketplace. I'm telling you, there's an extraordinary amount of risk in this marketplace. Nothing has changed as of today. Just because you see a bounce back up, don't put your party hat on. I'll remind you once again, the SPX today moved $40. The entire week was supposed to move $62. We're getting extraordinary moves, okay, in what still appears to be a lower implied volatility climate. Again, lots of opportunities are going to open up at this point in time. Okay, we'll cruise back over to the spiders and kind of clean up the chart. At this point in time, we are boxed in with our positions. We are waiting for a break in the market. If we explode higher, great. We'll throw in a few more bearish positions. If we just tear apart and head lower, great. Okay, we're positioned already for it. Again, I have negative delta. Those are bearish positions. We break lower, okay. All right. And at that point, if we break lower, we believe that the next move lower is going to see a wide expansion in volatility. And that, okay, would afford us the ability to finally be able to go out and to sell some premium. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.